Welcome back to the program. Show's called Your Money or Wealth. Joey Anderson, Big Al Clopine hanging out here answering your money questions. How does one figure out your risk capacity as you approach retirement if you have always been aggressive and have a high-risk stock allocation?
What do you think?
God. I mean, we need to know so much more. I don't know. What's your fixed income? How much money are you spending? How old are you? When do you want to retire? What is your timeline from retirement to, transitioning from a high-risk portfolio to a lower-risk portfolio? You want to have a portfolio based on risk capacity is one thing versus risk tolerance. And let me explain the two. Risk tolerance is these questionnaires that you get. And so, I think they help a little bit, but they're so biased on how that person's feeling on any given day.
Sure.
You know what I mean? Because you're answering questions. What would you do if the market dropped 10%? Well, the market's up 30, and I'd be like, I'm fine. I'm going to hold on. But if the market's down 20%, you answer that same question, you're like, I already lost 20. Now I'm going to be down 30? No way. I'm going to sell out, right? So that's like your risk tolerance. And then what advisors do with risk tolerance is they try to max out your risk tolerance. So your risk tolerance questionnaire gives you a score of this, so I'm going to build a portfolio. Well, that's my highest level of risk tolerance. So why are you building it around that? It doesn't make a lot of sense.
During a recession, that tends to change.
Yes, right. So risk capacity is really to determine what target rate of return that you need to accomplish your goals. And then building that portfolio around that target rate of return. And this is the capacity of risk that you probably need to take for you to accomplish your goals.
Right. And can you? So, right. So you got to check that.
So you check two boxes. It's like, all right, you need to get a 6% rate of return over the next 30 years to accomplish your goals. But if you're in CDs, in your true risk tolerance is that I cannot take any volatility whatsoever, or because I'm going to sell and I'm going to freak and I'm going to lose sleep. Well, then you have to adjust your goals.
Yeah, you have to lower your expenses.
Yes.
Now, here's another thing. After you do that, then take a look at what your fixed income or what your spending is minus your fixed income. So you're spending $80,000, your fixed income, Social Security, and pension is $50,000. So you need $30,000 from your portfolio. And we would say have at least 5 or 10 years of $30,000. So that's $150,000 to $300,000 in fixed income, in safe assets. So that's another way to see, are you okay?
Got it. So, all right, we got to take a break. Show's called Your Money or Wealth.
Are you prepared for retirement? Sign up for a free financial assessment with a certified financial planner professional from Pure Financial Advisors.